As world markets and currencies remain volatile, emerging markets may be forced to rethink their own growth strategies. Joining us now to discuss emerging market economies, especially now that we're seeing a very weakened dollar, is Kuseni Dlamini, CEO of Old Mutual South Africa, who's going to talk to us about emerging markets. Now, the idea of a second round of quantitative easing, Kuseni, has raised fears, obviously, of a weakening dollar, and we've seen the dollar weaken. But others are saying, well, this should present an advantage for emerging markets because we're going to see risk appetite return to emerging markets.
We see emerging markets as a pocket of untapped potential as Old Mutual. That's why we're very proud to use South Africa as our global headquarters to lead the charge into emerging markets. We saw recently the IMF released a report indicating that the prospects for emerging markets look very good, and we concur with that view, and that's why we're focusing on growing our business in those markets.
It's been said that emerging market countries at the moment are the ones that are intent on weakening their currencies in order to drive up their exports, and we've seen the strengthening of the South African rand. The question, though, is it a sustainable strategy at this point?
That's debatable, Lerato, and I think there's a big debate at the IMF. We saw the focus around the issue of currency. There's even rumors of a global currency war, and we see what's happening with the Chinese currency, and the South African rand has been rallying very strongly. And part of it may not necessarily be a result of deliberate interventions by governments in emerging markets. It may have to do with the very fundamentals of emerging markets, which actually outperform the fundamentals of developed markets. And we know that capital votes with its feet, and it follows with opportunity. And emerging markets are now, in the broader scheme of things, providing tantalizing opportunities for investors.
But what would be a balance? Because that's essentially what leaders at the G20 will be looking for.
Can you repeat the question?
I'm just saying, what would be a balance in the current situation? Because you've got a low interest rate regime in the Western economies. You've got what are emerging markets accused of doing is deliberately weakening their currencies, but effectively they need to mutually reinforce each other. So where would we find that middle ground?
Well, we'll see what's going to come out of the G20 meeting in Seoul next month, whether there is going to be consensus around a balance. And it seems to me what's happening now, by and large, countries are pursuing their own policies driven by their national economic objectives.
Andrew, just your views on this one, because in answering the question of whether or not some of these currency positions are sustainable, is the reality that not all emerging market economies have strong reserves, as you alluded to earlier on? There's Brazil that can afford it, China that can afford it, South Africa that can't afford it.
Well, I don't think Brazil can afford it, to be honest, as I think I think they're getting burnt because you've seen the rand continue to strengthen. So South Africa certainly doesn't have the reserves. But I think when coming back to emerging markets as a concept, is you have to focus on the word strategic, and you have to look and say that the currency situation that's going on at the moment is a function of certain economic circumstances, low interest rates overseas, slightly higher interest rates here. You maybe have to look beyond that and look and say, what do emerging markets offer as a concept and as a long-term destination of investment opportunity? And you know, as Mr. Dlamini says quite correctly, is the opportunity in terms of the demographics of emerging markets, in terms of growth opportunities. That's where the focus should be.
Let's talk about the emerging markets that get a lot of attention. India and China, both located in Asia, and we've seen equities rise up in Asia as people and investors put their money into those economies, hoping that the Asian economies would catalyze global growth. The question is, though, can India and especially China bear the pressure of being the ones that need to stimulate some kind of global re-engineering?
That remains to be seen, but by and large, those countries that receive a lot of attention now have really played a very important role in terms of leading the global recovery that we are talking about. To the extent that there is a recovery, it remains uncertain whether it's going to be sustainable. But those markets, what we see there, we see high economic growth rates, we see rising populations, we see more people entering the ranks of the middle classes, more people having disposable income, more people starting to invest the income that they have. From an insurance point of view, we see low levels of insurance penetration, and that provides us with a huge opportunity to be able to grow our markets in those countries.
Well, let's talk about that a little bit, Andrew, especially the situation in China, where we've seen the authorities trying to rein in credit supply, unbridled lending. But there is also a sense that the Chinese in particular are not very good at savings and that there aren't very dynamic pension systems within that economy. And one day, what we might see is an overheating of that economy or indeed asset bubbles in some sectors.
I think the savings issue, I might disagree with you on that. I think the Chinese are actually, on the individual level, if I'm not mistaken, are actually good savers of money. With the setup of their pension systems, Mr. Dlamini would probably be better qualified to speak about. In terms of asset bubbles, certainly questions around property, the speed at which it's going, and the stock market. You heard stories about people who would rather trade on the stock market than have a full day job because there was more money to be made. You have to ask questions around that. So certainly there are long-term questions, but the one thing that the Chinese have proved adept at doing is reining in policy, not being afraid to make quite tough decisions to try and slow things down.
Staying with China, Kuseni Dlamini, and this issue of savings, when you look at the GDP per capita in China, it's a tenth of what it is in Japan, for instance. So the Chinese are certainly not earning the kinds of wages that you see in the rest of Asia. And this is where this whole question of forward planning and a savings culture comes to the fore. But over and above that is the pressure that's currently on China to start to stimulate local consumption. But given the wage situation, people are saying it's an untenable situation that Chinese can be consumers of Chinese products and the Chinese will continue to be exporters of Chinese products.
You are right. When you look at the broader GDP per capita in China, it doesn't look as appealing. But if you start disaggregating the Chinese economy and the trends in terms of GDP per capita, we are seeing about 50 million people, for example, getting into the high net worth categories. And we're seeing hundreds of millions getting into the middle class. And we see good prospects from a market point of view. And the culture of savings is starting to take hold there. And our interaction with the Chinese insurance regulators have been very, very good. We've got a 50-50 JV business there with a big company called Guardian. We trade as Old Mutual Guardian in China. And our sales have been doing very well in the first half of this year. And we're looking forward to a very successful and very strong performance this year.
Okay, let's cross over the Pacific into Latin America. And obviously there the focus, emerging markets-wise, is on Brazil and Argentina, and to some extent on Chile as well. There we've seen higher reserve positions, for instance, in Brazil, better debt swaps, and also a return of risk appetite. Your views on Latin America, because some of the more controversial things that have happened around currencies and taxing of capital inflows have happened within that space.
We see Latin America as another pocket of untapped potential, and we've got two businesses in Latin America. We have a good business in Colombia. We've got about 38% of the retail affluent insurance market there. We're looking at diversifying into other segments of the market. We're in Mexico. We're in the corporate segment there. We're looking at piloting some products from South Africa into the Mexican market. Obviously, the greatest Latin American market is very exciting. We're continuing to analyze the other markets in which we don't operate with a view to look at expanding our footprint into those markets. We've found, by and large, very friendly regulatory regimes in South America. We've found governments that are very pragmatic and very prudent in their approach to economic policy, and we certainly are very excited by the prospects that we see.
Andrew, your views on Latin America. I'm mentioning the fact that Brazil, as we said earlier on, is the one that's trying to prop up its currency. Brazil's the one that's taxed capital inflows into that economy. In previous years, we've seen currency crises such as the peso crisis in Argentina. Are things as stable as they seem on the surface, because they also seem to be quite protective?
Yeah, I think that protection, if I understand it correctly, is more on interest-bearing products. So what they're trying to focus on is portfolio flows as opposed to fixed investment, which is probably where investors like Old Mutual would be focusing. The opportunity, I would imagine, for businesses like that lies in the demographic, in the expansion of the middle class, whereas your existing developed economies, you just don't have that growth. And we've seen a lot of companies get burnt in their endeavors in traditionally developed markets. So I think I would have to agree that Latin America has to be a major focus of not just insurers in the South African context. Retailers would also probably be having their eye on that.
Let's talk about those issues of demographics, because the one constant across emerging market economies is the high Gini coefficient. The fact that the rich are very rich and the poor may not be as poor as they used to be, but the gap is just too wide between the wealthy and the working class.
It does seem to me, Lerato, that most countries, even the developed countries, went through that phase. And I think the developing countries, as they are transitioning into becoming developed countries, are going through that phase which involves a widening of the gap between the haves and the have-nots. But over time, as the competitive forces of those markets, the productive forces get unleashed, then the gap has got to narrow at some stage. And that's what we are focusing on people who are becoming part and parcel of the mainstream economy, and for us that unleashes a lot of opportunity.
What about those developmental gaps, for instance? I mean, I know that in India you've got 300 million people who've now moved into the middle class category and earning better wages and having better access to schooling, but you've still got over 700 million people who are on the breadline.
Yeah, and from a social perspective, I mean, that's obviously concerning. From a business perspective, as those people start migrating into the middle class, very exciting. The issue, I suppose, though, is it comes down to politics, is does the government or whoever's in charge have the patience to actually let that sort of trend play out? Because it is a long-term process. It's a trickle-down process. It's a question of, do they suddenly get involved from a social point of view to change it sort of from a regulatory perspective?
What we are doing, just to add to that, Lerato, what we are doing from a company point of view, we are focusing on those people who are at the bottom of the pyramid. In South Africa, for example, we've got policies that cover the foundation market, which comprises people who earn from 1,000 Rand to 3,000 Rand. We're looking at doing that in the other emerging markets. We realize that there are issues of inequalities, and when we're looking at ways of being a positive and powerful force for good to bring many people into the mainstream of the economy.
Let's bring this conversation back home. The emerging market economies of Africa are effectively South Africa and Nigeria, to some extent Ghana, Mozambique and Kenya. But here we have huge infrastructure gaps. The leading economies of Africa don't really have consistent energy supply. We can't speak confidently about energy security going forward. We've got skills and education deficits across these economies, and manufacturing output is really weak. So just in terms of being competitive in the face of growth within other emerging market economies, Africa doesn't fare very well.
We're very excited and bullish about Africa. And you have highlighted the challenges. We are aware of them, and we are playing a positive and active role in addressing some of the challenges. What we've done within Old Mutual, we've established an infrastructure fund to deal with some of the challenges you've highlighted. We're looking at a schools and education fund to deal with the issue of skills. We've established an agriculture fund to deal with issues of food security, and we've also established a housing fund because there's shortage of housing everywhere you go. We want to be able to play a part in making sure that we address those challenges.
Okay.